All right, well, thank you so much for joining us. Today's webinar will be facilitated by Jen Ashley. Jen is the national leader of BKD's Accounting Outsourcing Services Growth Initiative, which harnesses technology to provide clients with cloud accounting support services and fully outsourced accounting operations, and provides outsourced accounting staffing, controllership, and strategic financial advisory services. He is a member of BKD National Manufacturing and Distribution Group and a private client services advisor. He provides accounting, tax planning, and consulting services for individuals and closely held businesses, and serves as the chair of BKD's Accounting Outsourcing Services Regional Committee. Jim joined BKD in 2004 and has experience identifying income tax solutions for businesses in the service, retail, and hospitality industries. In addition, he is a frequent speaker on the Affordable Care Act compliance and provides ACA-related consulting services for business. He is a member of the American Institute of CPAs, Missouri Society of CPAs, and the Ozarks Technical Community College Accounting Advisory Board. Jim is a 2004 graduate of the University of Missouri, Columbia, with a Bachelor's of Science degree in accounting and a Master's accounting degree. So this presentation, as I shared, is going to go over PPP and CARES. We have a lot of good information to share with you, so I'm going to go ahead and give it over to Jim. If you have any questions throughout the presentation, feel free to put those in the chat or use the Q&A feature. We will be addressing those at the end. But without further ado, I'll hand it over to Jim.
Thank you, Kay. I appreciate that. Good morning, everybody. It's great to be with you today. Lots to talk about. As you probably heard in the media, there's kind of been a refunding of these loans that are out there, so we're certainly going to hit that pretty hard. We'll also talk about some of the payroll tax credit provisions in both the CARES Act and previously in the Families First Act. And then we'll talk about at the end some cash flow tax planning strategies for your businesses to consider. And as Kay mentioned, this is being recorded, and we're certainly in an environment that is changing literally every day with new guidance and regulations. With today being the 29th of April, if you are listening to a pre-recorded session of this, just know there could have been additional guidance published after the fact. So with that being said, let's go ahead and get started. And interestingly, I'm actually going to start on a loan program that was in existence before the CARES Act, but was expanded with the CARES Act. And it's this Economic Injury Disaster Loan Program, or EIDL, or what I might just call EIDL throughout the presentation. And so basically what the CARES Act did is took an existing program that was really intended for businesses relief in natural disasters, think hurricanes, think tornadoes, earthquakes, etc., but expanded it to include the COVID-19 response. And so businesses are now eligible through the end of December. That those expansions include sole proprietors, they included independent contractors, and a big broad stroke here, employers not greater than 500 employees. Additionally, there were some co-ops, ESOPs, and some small business concerns, tribal small business concerns expanded as well. The interesting thing with this EIDL loan, also through the end of this year, this loan is not through an SBA lender, but instead directly through the SBA. So you would apply online through the SBA directly. Some of the other changes that the CARES Act brought were to not require personal guarantees. So anyone that's probably gone into business debt, most of the time lenders will require you to sign on, even though the loan may be in your business name, they would require you to sign on as a personal guarantee. You don't have to do so here for loans up to $200,000. You were previously required to be required to be unable to obtain credit elsewhere. They've waived that. They've also waived the requirement that you had to be in business for a year. All you had to be in business for was at January 31st, 2020. And then for some of these smaller $25,000 loans, they may approve you directly based on credit score. Okay, so what you may have heard about these EIDLs are these $10,000 emergency grants. And that was a hot topic for a couple weeks, where these grants were allowed. Once you apply online, they were saying, hey, within 3 business days, you could get an advance of up to $10,000. But what we found is they were so overwhelmed that it was much more than 3 business days. And they kind of changed the rules on us in the middle of the process, and then they said, okay, well, it's really only eligible for $1,000 per employee. So if you had at least 10 employees, then you could get up to that $10,000 advance. And really, they call it a grant, and it's an interesting distinction there because the grant in and of itself does not have to be paid back. Okay, so the EIDL is a loan, but this $10,000 advance or this $10,000 grant, that portion would not have to be paid back. Through the application process, and I'll hit on this on the PPP loan as well, you have to self-certify your eligible business for the EIDL program, okay? So keep that in mind. Self-certification is an important thing. We'll talk about that a little further in the presentation. And lastly, to the extent you get this $10,000 advance, it would reduce the eligible loan forgiveness should you also get a PPP loan as well. Okay, so what can you use the EIDL, the EIDL loan for versus the PPP loan? You may have heard that the PPP loan has kind of strict requirements of how to use the money. The EIDL loan has similar requirements, but certainly less strict. And I'm going to jump to that very bottom bullet point. Repaying obligations that cannot be met due to revenue losses. That's a nice broad bullet point. Where when we get into the rules regarding, hey, what can you spend your PPP funding on, you'll see it's a lot more restricted. So I guess I'll just leave you with the thought of, hey, you'll want to use PPP loans for its intended uses, and then EIDL loans, should you get it, for other uses that cannot be met due to revenue losses. All right, some practical considerations on the EIDL. Again, that self-certification is required. As mentioned previously, you apply directly through the SBA. You may want to talk to your SBA lender just for advice on it, but you wouldn't work with your SBA local bank. You would apply directly through the SBA. You can get the PPP loan, but you just can't use the proceeds for the same use. And even though the application process is maybe a 15-minute process, you want to have your numbers in front of you, your revenues, your cost of goods sold or cost to earn revenue for the trailing 12 months. If you have any rents, you'll want to have that in there as well. Then any other sources of proceeds that you've received during this, during the COVID-19 environment. Okay, so the big topic in today's presentation is the PPP loan. And let me first start off by saying the PPP loan is a new loan that was basically a new option included within an existing program of the SBA, the Section 7A program. So you kind of have to get a feel of what the 7A rules are. And I think it's really critical to work with an SBA lender that understands those rules very well. So if you've got an existing lender, I would certainly start with them, certainly if, in particular, if they are experts in the SBA. There is a forgiveness eligibility, okay? It's not a guarantee, it's not a right, it's more of a privilege. You gotta earn it. This forgiveness is earned. Also with the PPP, these definitions are really, really important. And there are things that you need to be clear on, things that you'll need to understand what you're getting into. Dates are very important. How they define employees is really important. And there's still a lot of room for clarity and regulation that myself as a practitioner and others like me are really hoping we'll hear from the SBA soon on that. Okay, so the PPP loan, and you may have heard, hey, the idea behind this is, you know, we want to keep people employed. Okay, so they have this unique definition of payroll costs. And interestingly, as you go through the application process, you don't necessarily ask, in fact, you don't ask for an exact amount. Instead, it's a formula-based application. So they basically say, okay, you take your payroll costs, the average payroll cost over the 2019 calendar year or a trailing 12-month period, you multiply that by 2.5, and that's the loan you get. And so it's really bizarre because it's a formula. You don't go to the bank asking for a specific dollar amount. It's going to the bank with your payroll records and using a formula to determine what loan you will get. So how do they define payroll costs? So certainly kind of gross payroll from your payroll records. There has been additional guidance regarding partners in a partnership. You can count their self-employment income as wages, even though they're not technically W-2 type wages. There's a limit on $100,000. Group healthcare benefits counts as payroll costs. So even though you in your mind you might say, and certainly in mine, like, well, that's not payroll, that's a benefit. Well, it counts for quote unquote payroll costs. Same thing for retirement benefits. These are quote unquote payroll costs. The payment of tax or local tax assessed on the compensation of employees. So in most states, that'll be like your state unemployment tax, okay? It excludes, you cannot include payments that you made to 1099 contractors or other sole proprietors, as they are actually eligible for their own loan. And speaking of them, they will basically walk into a bank using their 2019 Schedule C. So if any listeners are sole proprietors, you'll want to make sure you either have your 2019 taxes done, or you have a draft version of your 2019 Schedule C, because that is what you will need to get your loan. So what does it exclude? So we talked about the rule for partners in a partnership with a ceiling of $100,000. Well, employees that earned in excess of $100,000, that compensation is excluded. So to be clear, the first $100,000 is allowed. Okay, so when you're walking through that payroll cost, that monthly average to multiply by 2.5, there's a ceiling there. It's $100,000 on the annual basis. Okay, now what they don't limit is your benefit. So that employee may have earned more than $100,000, but you can count 100% of his or her health insurance or his or her 401k retirement benefit. It excludes also the employer share of FICA. So even though you might think gross payroll, it's not like super gross, if you will, where the employer share of FICA is excluded from that. If you have employees outside the United States, they will not count for this purposes. And then there's really kind of a no double dip policy. There are benefits from the Families First Act for qualified sick leave or qualified family leave that are funded through tax credits. You can't count that as well. Okay, so who's eligible for these? Well, the 7A program is intended for small business concerns. And so basically, how's that defined? Well, you got to be organized for profit. You have to have a place in business in the United States. You have to primarily operate in the U.S. or make a significant contribution to the U.S. economy. You have to be independently owned and operated, and you can't be dominant in your own field on a national basis. Okay, so that's kind of the textbook definition, small business concern. Like I said at the beginning, they've expanded the definition. So it includes any business, 501c nonprofit organization, a veterans organization, or a tribal business concern, if they don't employ more than 500 employees. Okay, so again, similar to the EIDL loan, they said if you are under 500 employees in your company, even though you may not be a small business concern, you are eligible. You can also look at if you are over 500, you're not automatically out. The SBA has an employee size standard chart on their website that you can look. And so if you're at 550 employees, for example, well, you'll want to double check for your particular industry. And it's based on a North American Industry Classification, or NAICS code. And again, you can find that on their website. What the employee size standard is for that industry. Lots of industries could be in the manufacturing realm in particular, have been in the 750 to 1,000 to 1,250 employee industry. So there could be lots of opportunities out there. For small business concerns, as defined previously, you can look also at a revenue-based size standard. So some of those NAICS code size standards include a revenue-based size standard in addition to the employee-based or alternative to the employee-based. Then lastly, there were some regulations clarified on the 6th of April that, hey, if you can also look at as a small business concern, you can run the test of, hey, did my business's net worth not exceed $15 million on the 27th of March? And the last 2 years' tax returns, were we less than $5 million, okay, of net income? Again, similar to EIDL, our friends that are sole proprietors, 1099 contractors are eligible. Again, you'll need that 2019 Form Schedule C and then proof of being in business as of February 15th, 2020. Other eligibility rules, I don't know if it's going to impact the audience today, but for those industries that were hit especially hard, hospitality, restaurants, they are given an expanded eligibility. They can waive affiliation rules, and that's a whole nother consideration within the 7A program is if there's business affiliation. So if the same owner owns multiple businesses, you have to combine all of those employees because they're deemed to be affiliated. So you may have multiple businesses that are under 500, but if you combine them in total, you're over 500. You have tripped the trigger of the affiliation test. There are exceptions, like I said, the NAICS code starting 72, hospitality restaurants, franchisees, certain franchisees are accepted, SBIC businesses are accepted, and then there is a limited exception to faith-based organizations that the SBA provided guidance on the last couple of weeks. If that faith-based organization is affiliated with other faith-based organizations, so like a church is a member of a state board of churches or a national chapter of churches, you don't have to consider that for affiliation churches. But it doesn't mean, hey, a faith-based organization, if there is some sort of control or affiliation with other non-faith-based companies, that affiliation would still apply there. Okay, so the loan, and we talked through that math a little bit already. It's that monthly average payroll cost times 2.5. There's a ceiling on that of $10 million. That's obviously a big loan. You will look at your payroll records for the last calendar year, the 2019 calendar year. You can also technically look at the trailing 12 months, but most banks are now asking you to bring in the 2019 calendar year payroll records. If you weren't in business during a period in 19, then you can look at payroll costs during the first couple months of 2020. Okay. So we talked about how you get the loan, what the loan is calculated, who's eligible. I had referenced during the EIDL or EIDL part of the presentation, what can you spend your money on? And I said, hey, you are restricted here with the PPP loan. So here's the allowable uses of the PPP loan. So payroll costs, as we talked about earlier, costs related to the continuation of group health benefits during periods of sick, medical, family leave, and related insurance premiums. That's a specific segment there. The payroll costs, that first bullet point again, includes regular health insurance premiums and regular retirement benefit. Interest on any mortgage debts, okay? So that's an allowable use. We'll talk about what is allowable for forgiveness, which you will learn that there are some differences here. You can't prepay your loans. You can't use it to prepay more than an 8-week period worth of loans. You can't use it for payments of principal. You can use it for rents. You can use it for utilities and interest on any other debt obligations that were incurred before the covered period. So covered period is an important term. The covered period is the date you get the loan. It's an 8-week period on the date you're actually funded. It doesn't mean the date you applied with the bank. It doesn't mean the date you were approved. It was the date the bank gave you the funds. and it's an important 8-week period. Okay, so as far as going to the bank, you may have already seen the application. You can download it online. Your bank will have it handy. It's really not a complicated application. It's a 2-pager, but there are some things in there you have to make good faith certifications about. And this first one is a big one. Uncertainty of current economic conditions make necessary the loan request to support operations. It's an extremely broad category. What does that mean? Well, I can tell you it's unclear, and we've certainly advised that clients talk to legal counsel if they otherwise feel like, hey, we're doing okay. Maybe we've got other sources of liquid capital or other lines of credits. Does this mean we're excluded from applying for PPP? I would certainly recommend consulting with an attorney on that, because you are self-certifying to the federal government, basically, that you meet that. You've probably seen in the media some of these large companies are catching a lot of flack. The Treasury Secretary announced yesterday that loans over $2 million, they're basically going to review those in detail, the SBA is, whereas previously all that they were requiring was the bank to kind of sign off on forgiveness. Okay, so also in that loan application, there is a statement that says, hey, not more than 25% of the forgiven amount may be for non-payroll costs. So we talked about the allowable uses in the previous slide. Obviously, the whole idea here is to keep people employed. What was a bit of a curveball is this distinction of, hey, you've got to use 75% of the loan, or maybe the forgiveness portion of the loan, for payroll costs. We did not, that was not actually in the law. That was an interpretation from the SBA and regulations. You can't have multiple loans. You can only have one. And then lastly, you have to self-certify, hey, these funds will be used to retain workers, maintain payroll, make mortgage, lease, utility payments. And, you know, again, I put that little observation down there. You can't knowingly use it for unauthorized purposes. The federal government is getting a little upset about this stuff. And frankly, there is also a Freedom of Information Act disclosure in that loan application. It's way in the back in the fine print. But, you know, that could very well mean that, you know, whether it's a national media outlet or your local business journal could theoretically dig in and find out who got these loans. So please keep that in mind. Other things to note on PPP, there is no guarantee required. There's no collateral required. Similar to EIDL, they waived the requirement that you had to get, you were unable to get credit elsewhere. You've got to disclose your ownership and management. Remember the affiliation rules we talked about. Payments are going to be deferred for at least 6 months. And I think that's a pretty set figure at this point. So you can count on 6-month deferral of payments. You are not prohibited, as mentioned earlier, not prohibited from also getting that EIDL loan, but you have to use it for different purposes. So remember when I talked about that broad category of EIDL loans, other expenses that cannot be paid due to revenue losses, you know, that could be your supplies, that could be any other sort of overhead costs that aren't payroll, that aren't mortgage interest, that aren't utilities, that aren't rents. Okay, so to the extent that maybe part of your loan is not forgiven or was not used on appropriate costs, then the loan will, it's being mandated that it will be a 2-year loan at a rate of 1%. So the rate is really, really inexpensive, right? That's really cheap money. But a 2-year loan is a very fast payback. So that's a lot of cash going out the door. And if you think about it, again, from that fourth bullet point, the payments are deferred for 6 months. So you really will only have 18 months to pay back the adjusted amount. And lastly, that bullet point I already mentioned earlier in the slides, the SBA is going to audit or review forgiveness on loans greater than $2 million. Okay, so the forgiveness feature, this is the big, you know, discussion right now. Lots of clients, lots of businesses have gotten this loan already, and now they're asking these questions on forgiveness. What do I need to track? How can I spend it, etc. You've got, again, those payroll costs. But here is a little bit of a change in definition. Interest on covered mortgage obligations, payments on covered rent obligations, and payments on covered utility obligations. What's that word covered mean? Well, essentially, the covered mortgage is a debt that was incurred in the ordinary course of business. That's a liability of the borrower. That is a mortgage on real or personal property that was in place as of February 15, 2020, okay? You may remember allowable uses of PPP were for any loan debt, but for forgiveness, it's only allowed for mortgages on real or personal property. So if there are lines of credit that are, don't have collateral, real or personal property collateral, that would not be eligible for forgiveness. Okay, so important distinction there. Covered rent. So instead of any rent, well, that means rent that was in force or in place as of April 15th. So basically, if there was a lease in place as of, I said April, February 15th. So the lease had to be in place as of February 15th. Utility payments, okay? So these had to be utilities that you were already engaged with a company as of February 15th as well. That think of, your natural utilities, electricity, gas, water, telephone, and the internet are also included there. The forgiveness part they specifically say cannot exceed principal. I think that goes without saying, but they wanted to make that clear. And another really nice feature here is most of the time when debt is forgiven, it's considered taxable income. They specifically said any forgiven debts for PPP purposes will not be considered taxable income. So that's a nice win. Okay, so you may remember I said it's a privilege, not a right, in this forgiveness feature. And so here's kind of the details of what I mean by that. You've got to basically keep the similar amount of people employed. And they say you've got to have, you will do a test of your full-time equivalents during that, again, 8-week cover period. Compared to your full-time equivalents during the measurement period. And for most businesses, that measurement period, you'll look at the FTE count between February 15th, 19 and June 30, 19. You have the option, you can elect to substitute that 2019 period for a period starting in January through the end of February of 2020. So that's a nice feature. You'll want to do what makes most sense to you and your business. Interestingly, and one of the items that we're really looking for guidance on is they forgot to define what full-time equivalent even means. So that phrase actually kind of derived from about 10 years ago, the Affordable Care Act, where you may recall hearing about, hey, a full-time equivalent is someone that not works 40 hours a week, but works 30 hours a week, which we were all kind of thought was a bizarre rule that you were defined as full-time when you work 30 hours. Well, is that what they're referring to here? We really don't know, and we're really hoping for additional guidance very, very soon on that. There is also, in addition to your FTE count tests, you also need to look at, did you reduce salaries or wages of any of your employees during the covered period? And for this purpose, it's any individual employee. Now, there is an exception. If an employee during any pay period in 2019, during the prior year, earned more or had an annual rate of more than $100,000, it doesn't matter if you reduce their compensation. They're really concerned with the employees under $100,000. Did you reduce their compensation instead? So during that 8-week period, you will look to see if, hey, during that 8 weeks, you will compare their salaries and wages compared to the prior full quarter. Okay, so the most prior full quarter for everybody is first quarter of 2020. So that's January through March 31st, 2020. And excuse me, the prior full quarter is, there's a haircut at 75%. Okay, So it's a little bit of math here, but basically what you're saying is, okay, the prior full quarter was 13 weeks. 75% of that is 9 3/4 weeks. All right. The the 8-week period, when you compare it to 75% of the first quarter, is obviously shorter than 9 3/4 weeks. I don't know if that's what they actually intended, because it seems really bizarre, because unless you actually pay people more money, they're always going to get paid more, even if you kept their salaries the same during a 9 3/4 week period compared to an 8-week period. So that is certainly an area that we're hoping for additional guidance very, very soon on. There is a forgiveness, get out of jail free card almost, this exemption for rehire. And this is also, I'm going to sound like a broken record, a section we're hoping for some clarity on for additional guidance. But basically, they're saying, look, if you had layoffs or reductions in wages between February 15th and 30 days after the signing of the law, which it was signed on March 26th, so April 26th, that will be disregarded if you can eliminate those reductions in FTEs or reductions in salaries and wages by June 30th. What in the world does that mean? Does that mean anything that we shorted them on, I got to pay that amount by June 30th? Or does that mean where maybe we dropped wages 30% across the board, I just have to restore their wage to what it was on February 15th. I just have to restore it by June 30th. Gang, I don't know. And a lot of practitioners are scratching their heads and really kind of almost screaming at the SBA for additional guidance on that. There was in the CARES Act itself, there was this note that they plan to certainly prescribe additional regulations again, which we're waiting for, but there might be a de minimis exemption out there. So, keep your fingers crossed that it will simplify things, this de minimis exemption, but more to come. Okay, so how does the CARES Act correlate with other, how does the PPP correlate with other provisions in the CARES Act? Well, in addition to the PPP, which is one of the defining facets of the CARES Act, there are some credits, some payroll tax credits out there, an employee retention credit, and there is a payroll tax deferral, okay? And deferral, be careful with that word. It means just delaying into the future. The pipers will still have to be paid, but it's a nice way to at least save money today, kind of take an advance almost against payroll taxes, but you'll have to get that paid up in the future. So the retention credit, you cannot get retention payroll tax credits if you get the PPP loan, okay? So if you don't get the PPP loan, then you will certainly want to look at the eligibility and opportunity for employee retention credits. The deferral of employer share payroll taxes, that is allowed for applicants of PPP loan, and you can continue deferring until the date of forgiveness. So if you got a loan today, you've got the next 8 weeks to incur your costs. And then 60 days after that, up to 60 days after that, you'll want to ask for forgiveness from your lender. During all that period, up to the date that the bank actually says, hey, this is the amount forgiven, you can, if you so choose, defer your portion of payroll taxes, okay? Okay, so here's some kind of big, broad guidance on the PPP loan. It's a first come, first serve approach. And, you probably heard in the media that $349 billion, that round one, that was approved back on March 27th, that was gone in 2 weeks. That's a lot of loans made. Round two, which started earlier this week, is $310 billion. I'd anticipate that would go just as fast, if not faster. So if this is something you're interested in, get in front of a banker now. This 75% payroll versus non-payroll costs, that's a really critical item to be mindful of. We don't know if you have to spend 75% of the loan on payroll, or if you have to spend spend 75% of the forgiveness portion on payroll. Okay, we're looking for guidance there. There is a bit of what I might call moral hazard out there, where the federal government has subsidized state unemployment. States have to opt into it, but basically there's an additional $600 per week that employees can get in addition to their state unemployment. For a lot of employees, they're almost tempted to stay on unemployment because they're making more on unemployment than they were as an employee. That's not good for business, right? Certainly not good for that employee in the long run if they had any benefits. But obviously you want to keep your good employees in-house. So you're unfortunately kind of in competition with the unemployment agency with your employees. And that's just the reality of it. Big picture, do the analysis. You want to look at the EIDL loan, and you want to say, okay, do I want an EIDL in this PPP loan? Or does that employee retention credit make more sense instead of the PPP loan? In which case, I would certainly obviously look at the EIDL loan regardless. But with the either or on the PPP versus employee retention credit, there's going to be some economic and administrative burdens there. And there seems to be, in my opinion, more and more administrative burdens as put down by the SBA. All right, just to keep things moving on time here, we're 37 after the hour. I'm going to go a little faster on these slides because I do want to leave time at the end for Q&A. So the Families First Coronavirus Response Act, that was another massive piece of legislation that was almost kind of forgotten about. So it basically said, hey, for government agencies and then employers less than 500 employees, you have to pay emergency sick leave for COVID, and you have to pay emergency family medical leave for COVID. And that could include situations where your kids are out of school and you have to go home to watch them. And so employees, could get this. If you're under 500 employees, you're required to pay it, but the government turns around and allows you a credit through your payroll taxes to fund it. So you kind of have to advance it on the front end, but you get it back on the back end. All right, the retention credit in and of itself, I've spoken on it a couple times already. It's an interesting credit out there. It's for 50% of wages for each employee up to $10,000 of wages. So basically it's a $5,000 credit per employee, which sounds really nice. And if you got a lot of employees, that could make a lot of sense. You look at dates from March 12th, so they kind of backdated it to March 12th, and it's allowed through the end of the year. You will have to confirm that you had a trade or business during the calendar year 2020. If you're under 100 employees, then it's a pretty straightforward calculation. You either say, okay, did a local or state government limit commerce in my area? In my home state, we're in a shelter-in-place order, so we can certainly make that argument for many businesses. Or you can say, hey, looking at my gross receipts for second quarter 2020, will that be less than 50% of the gross receipts during second quarter 2019? And if yes, then I can look at this credit too. Interestingly, the way they define that is, hey, you will then look at, you will continue to get this credit until the quarter for which you exceed 80% of gross receipts of the prior year's quarter. So another way to think about it is, if you're eligible for one quarter, you'll automatically get it for the next quarter. Okay, so it's a nice benefit out there and could make a lot of sense if you weren't able to get the PPP loan, or if that's something you don't want to do. Ineligible employers, unfortunately, there's a few government employees. And again, as previously mentioned, if you had a PPP already, if you're over 100, it's a little more complicated. You basically have to say, hey, the employee was unable to work even at home. If it's under 100 employees in your company, it's a lot more straightforward. You do, again, you count their wages. You do also get to count their qualified health plan expenses, but most employees are paid more than $10,000, so I'd anticipate most employers would just track that. Okay, there's a no double dipping. So if some of these employees are already getting the WATI tax credit or any other paid family medical leave credit, you can't get the employee retention credit for them. Interestingly, there is deposit relief on this. So it's funded through the payroll tax system. So the IRS has advertised you can kind of short us on some of the payroll taxes in anticipation of this credit. I've never, ever, ever heard that or advised that in my entire career before, but that is what they're saying at this point. If you are in a desperate situation where even if you were to short your federal tax deposits in anticipation of these credits, there's a new form out there, Form 7200, where you can basically request an advance of this credit. Otherwise, it gets reconciled at your quarterly payroll tax returns. So real quick example here, a 75 person employer operating in 2020, your second quarter dropped by more than half as compared to second quarter of 19. They paid their employee Mary $7,500 wages for services and also paid $1,500 of health plan expenses on her behalf between April 1 and June 30th. So there's the $7,500 wages, $1,500 in qualified expenses for health, total of $9,000. Multiply that by 50%. There is your $4,500 credit. And the $500 difference to get to that ceiling will apply and be applicable to third quarter and possibly fourth quarter as well. The deferral payroll taxes, you remember when I said that Piper's got to be paid at some point? You're looking at deferring payroll taxes through the end of this year, okay? And it's the employer's portion of Social Security, not the entire amount of payroll taxes, not the Medicare amount, but just that Social Security portion at 6.2% and the employer amount. You can defer that for all the way through, half of it, all the way through December 31, 21, and the second half of December 31, 22. But remember that the paper has to be paid, and that could be a nice large amount of cash to save temporarily, but you've got to get that paid into the government eventually. Okay, let's talk about things you should consider doing right now. So first and foremost, if you don't have a group of trusted advisors, whether that's a CPA firm or legal counsel or insurance or anything of that nature, a lender, you got to find them. And you want to work with them. You want to rely on them as much as possible right now. There are lots of tax incentives out there as part of the CARES Act that I haven't presented on in this. There's net operating loss carrybacks, which were basically eliminated with tax reform a couple of years back. They've brought that back. So if you have losses, you can carry those losses back to prior profitable years and get tax refunds. Qualified improvement property. This is a big darn deal, and it's kind of complex, but basically there was a rule for leasehold improvements internally to a building, okay? That said, they intended it to say it's eligible for immediate write-off, or you can choose to write it off over a 15-year life, but they wrote the law incorrectly, okay? And this is going back to the tax reform days of a couple years ago. They wrote it incorrectly, and so the IRS interpreted that as, sorry, you wrote it incorrectly, you're stuck capitalizing that and depreciating it over a 39-year period. So for those internal leasehold improvements where businesses were planning to take that tax write-off all in 1 year, they are stuck depreciating that as a straight line percentage over 39 years. That was nasty. Well, they fixed that. And so that's created opportunities not only for the 2019 tax year, the 2020 year, but you could go back to 2018 and amend a return, which, by the way, will reduce taxes in that year, which, if it's a large enough leasehold improvement, could create a loss on your return, which you could then carry back and get more taxes on, okay? Corporate AMT credits are now more available than they were previously. With tax reform, they kind of pushed out how quickly you could get any of your AMT credits back. So lots of tax incentives to be mindful of. As a business in and of itself, you will want to start looking to forecast your cash. You want to budget and forecast. And we recommend kind of a quarterly cycle, a 13-week cash flow cycle. You want to look at where your break-even analysis is. hey, what kind of marginal revenue do I have to get of gross profit to meet my fixed overhead costs, okay? You want to analyze those variable and fixed costs, and anything that is non-essential you want to consider eliminating. You will also want to make sure you've got realistic revenue projections here. I've worked with a lot of entrepreneurs that are ultra positive, and I don't want to be the Debbie Downer, but gosh, if there's a shelter in place order and I work, with a restaurant, like if you don't have a drive-through, boy, your revenue is just going to have a disastrous drop there. So, you need to be realistic about your revenue projections. Work with your lender, and not just on the PPP loan, but any other forms of lines of credit or any other working capital. You want to look certainly at the economic injury disaster loan. And that's how we started the presentation. Remember, you can get that advance up to $10,000 that doesn't have to be paid back, even if they decline you for the loan in and of itself. Now, the loan has to be paid back, but that up to $10,000 advance doesn't. So to me, assuming you can self-certify to the rules on that, then I think that's kind of a no-brainer. And then you'll want to look at analyzing between the PPP, that payroll protection loan, talk to your SBA lender, but also be mindful and work with your CPA or advisor on the employee retention credit and do the math on what makes more sense for your business. In reality, you want to make sure you're focusing on your cash burn rate, okay? Lots of businesses are burning through cash a lot more rapidly than they have previously. These loans and these opportunities out there are great, but if we're not out of this in 8 weeks, it's going to be tough. And so you want to be mindful of that, the short-term storm here, so you can be long-term ready to reemerge when the country reemerges from this. So as a side note, I work with a lot of funeral homes. I understand that's not necessarily the industry I'm speaking to today, but maybe a sister industry of yours. There are all sorts of weird situations with various states and shelter in places and allowing only up to 10 people at a funeral. And it's been tough. And lots of families are looking at cremations a lot more than they ever have before. And so I know the funeral industry, even though it's kind of a unique industry, it has gone through a lot of unexpected road bumps here. You're obviously at the point where you don't really know and you can't necessarily predict volume of death and volume of families you're going to serve, but the short-term trends have been tightening the belt with families. Okay, so I hope that was helpful. I am going to open it up for questions. I am hopeful Kay has been keeping track of that. I have been focused on the presentation in and of itself. And Kay, if you've got any questions queued up, I'm happy to address those over these next 11 minutes.
Yeah, so the first question that I have here is from earlier. It was, did I hear that telephone and internet are considered utilities? Those be considered utilities? They are
in the CARES Act in and of itself. It specifically spelled out internet and telephone, which, you might think, well, that's a pretty broad definition, which is great, but it is in the CARES Act, so yes.
Awesome. Another question that we got through the chat was, any idea when SBA will start taking new applications on EIDL?
If they haven't done so already, I would jump on that after this presentation. They are supposed to have that up as soon as possible. I know the president signed it into law a few days ago. So they refunded it. I know with PPP, they waited for over the weekend so banks and systems can kind of recalibrate, so to speak. And I think those became available on 10:30 a.m. on earlier in the week. But as far as the EIDL, boy, I would have anticipated that had already been up. But if it's not, I'd say as soon as possible.
Awesome. Another question through the Q&A is about a specific situation. someone received $10,000 in an EIDL grant and the PPP loan. Can you explain if the $10,000 will be forgiven or not?
Yeah, so that $10,000 on that grant, you don't have to pay back. Okay, so that is the good news. What they've done is said, okay, that will lower the amount of forgiveness on PPP. So let's say you then take a PPP loan of $100,000. Well, they're going to subtract out the first 10,000 of that from forgiveness. So you're already a little bit behind the curve, so to speak, in terms of forgiveness, and that only 90,000 of that original $100,000 PPP loan is eligible for forgiveness at that point.
Thank you. One other question I see that we got through the chat, can covered rents include rents paid on tangible personal property such as copiers?
You know, that is an excellent question. And there was guidance issued, interim final guidance issued, and it was focused on our businesses that are kind of sole proprietors in nature. And although they didn't say that was their interpretation, they did make reference to renting personal property. So I guess I tell you, certainly if you're a sole proprietor, they've already kind of acquiesced to that. They haven't broadly said that for sure, but I think it kind of gives you a sneak peek of what they're thinking.
All right, I don't see any other questions in the chat now. So I think we are all set on that. And thank you so much, Jim, for joining us today and presenting. As I mentioned earlier, we will be sending out an email to all of the webinar attendees today with a copy of the recording. And we will include Jim's information on the BKB page in case you have any follow-up questions. You're welcome to send those directly. Sorry, we've got one more question that just came in that I want to make sure we hit. If documentation on the PPP loan exists for 75% spent on payroll, is it all forgivable or will some be due? Yeah,
that's a good question. I really like that. So the 75% rule is more of a, hey, of eligible forgiveness or of the loan in and of itself. And again, we don't know, but you've got to use 75% of it on payroll, which means those other costs, that covered interest, covered rent, covered utilities, it could have been more than 25% of the loan, but you will take a haircut on the amount that is over 25% of that loan. In other words, the only thing for forgiveness purposes, keep in mind, you have to spend at least 75% on payroll.
Wonderful. And we got two more questions.
Okay, good.
Great. So someone wrote, I have a business loan from when I bought the business. Will that interest be forgivable under the PPP loan?
So it is, it really depends. Does it meet the definition of a covered mortgage? And remember, covered mortgage is interest that was on a loan that was in place as of February 15th. Okay, so that's test number one. Was this loan in place February 15th? And was it collateralized with real property or personal property? So when you bought the business, how was that loan collateralized? And so if it was, the assets of the business, maybe it's a building, maybe it is the inventory. Again, real or personal property, as long as it's collateralized by that, it meets that definition of covered mortgage interest. And so you can use PPP funds to pay that interest. You're still subject to that 75-25 rule. Okay, so remember, you still have to pay at least 75% of the loan or the eligible forgiveness amount for payroll. But to that specific question, it's an allowable cost for sure.
Wonderful. Yeah, and the follow-up comment to the person who asked that question was that the business loan does include all the physical items of the business plus some goodwill.
Okay, so the goodwill is tricky. because Goodwill is not real property and not personal property. And so I would recommend consulting your tax advisor and or legal counsel on that. We don't have clarity on something like that. It's a pretty nuanced situation. So are you, would you, for example, be forced in the situation of, hey, when you bought the business, 25% of it was Goodwill and 75% were the assets of the business? Does that mean 3/4 of that interest is allowable? Maybe. I don't know. I don't know. It's something that ultimately you're going to want to get comfortable with your tax advisor and or legal counsel to submit that as a cost.
Wonderful. And one last question before we wrap up. Is the loan forgiveness based on cash or accrual method for the 8-week covered period after loan disbursement?
Boy, I love that question, and thank you for asking. Okay, so this is driving accountants crazy. The phrase they use is incurred and paid. Incurred and paid. So anyone in the accounting industry will probably interpret that to say, well, that's kind of both. Incurred is a phrase you would use in accrual method accounting, and paid is a phrase you would use in cash method accounting, okay? We don't know is the answer at this point. So I've got clients that have gotten loans, and what I've done with them as they're getting their first payroll cycle during this 8-week period, that payroll cycle may have included days that were before the PPP loan, okay? So only a portion of that was quote unquote incurred during the 8-week period. Even though the entire amount of the payroll may have been paid, only a portion of it had been incurred. So that's a real conundrum. So what do you do? And so what I've done is told my clients, look, I think you need to calculate it both ways. What is the incurred and paid amount versus just the paid amount? And hopefully by that 6th or 7th week of your 8-week period, the SBA will have published guidance on that of, okay, here's what we really meant by incurred and paid. It really literally means cash basis, you're good to go, or it literally meant accrual basis, you're good to go. But gosh, the honest answer is we don't know. And we're advising our clients to run it both ways.
Wonderful. All right, so those are all of our questions from today's presentation. Like I said, if you have anything else that comes to mind afterwards, you are welcome to reach out to Jim directly. We'll include his information in the recap email. Thank you so much for taking the time out of your day to join us. We hope you have a great rest of your day.
Thank you. Best wishes to everyone.